The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The rebound rally extends into a second day. Tech stocks rouse from their slumber. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. Here is your setup with just about an hour to go. The S&P 500 higher by about 0.5% right now. You can see that the bond market remarkably well behaved today, pretty much unchanged when it comes to your 10-year treasury yield. And then you take a look at tech stocks. Of course, they were beaten up on Tuesday. You can see that they're slightly outperforming the S&P 500 today, higher by about 0.7%. But the small caps, once again, just ahead of the pack. The Russell 2000 higher by about 0.8%. I believe this is the 14th straight day, Romaine, that they're outperforming the large caps.
That is right, Katie Greifeld. I have to grow a few more fingers, but I'm really intrigued today about the rebound that we've seen in the AI trade, roaring back with the Global X Artificial Intelligence ETF posting its best two-day performance in a month. Datadog, Microsoft, Dell having their best days since November. And then there's Intel, the once laggard, now a world beater, the best performer in the NASDAQ 100 so far this year, ahead of earnings tonight that may show more room to run and, more importantly, more room for a broadening out in the AI trade.
I don't think there's any uncertainty about AI. There's no question of hundreds of billions of dollars is needed to build this out. The CapEx is going to drive more global growth. How that is going to be dispersed and where it's going to be really dependent on each and every government. But I sincerely believe there is no bubble in the AI space.
Well, we may find out tonight. And while the rally today is nowhere near as broad as yesterday, it's not confined to AI. Procter & Gamble, Eli Lilly, Wells Fargo, Carvana, all seeing strong bids today. Caterpillar, that's at a record high. Pest control company, Rollins, at a record high too. A boost for the cyclical space and a boost for the small caps too, amid still strong economic data trickling in, including figures that indicate personal spending kept on revving in the fourth quarter of last year. Now, we're not in the clear yet, though. The Fed's preferred measure of inflation still stuck near 3%. And while wages are up when adjusted for inflation, disposable incomes, they're flat. On top of that, market positioning still a bit defensive. Open interest in the VIX as of yesterday as far as call options relative to puts near their highest since March. And most of the bets clustered between 30 and 35 strike prices for mid-February. That's about double where we're at right now. So that indicates high conviction for volatility spikes by the end of next month.
Yeah, it'll be interesting to see how that dynamic evolves. But I wanted to go back to tech valuations because tech has been the relative underperformer, and we know it took a beating on Tuesday. But let's take a look at how valuation stacks up historically. These colored circles that you can see here basically highlighting past bottoms when it comes to your Magnificent Seven. And we're taking a look at the forward PE ratio here. And you can see that where we stand right now, 28, it's kind of in the middle when you take the chart back to 2018. Certainly, we've been much, much higher than this. Think about getting close to 45 during 2020. And then you think about past slumps. We're nowhere near where we've been in the past couple of years, nowhere even close to where we were in 2025 as recently as last year. So in terms of valuations, not too much of a signal here, Romaine. But again, there is that old adage that valuations are a terrible timing tool. All
right, well, let's kick things off to the close here on this Thursday afternoon with Amy Kong, partner and wealth advisor over at Corient. Great to see you, Amy. Great to see you. Let's talk about just the complexion of the tech trade, because, I mean, a lot of people look at those really mega cap stocks, the NVIDIAs and Microsofts, and some of those names haven't hit record highs since December, November, even September of last year. But there's this whole other cohort of AI, or I should say tech stocks, that seem to be getting a pretty big lift. Intel probably emblematic of that.
Yeah, absolutely. I think in general, you are seeing a rotation out of the big winners from last year. And so these other tech companies, small cap, mid cap, even the 493 names in the S&P 500 are seeing a relative boost on a year-to-date basis. Not surprised, right? If you look at the mega cap winners from last year, they have been the winners, the dominant players for such an extended period of time. A rotation like this is absolutely not a surprise.
The other thing we talk a lot about, at least over the last 14 sessions, as Katie alluded to, is the outperformance of the Russell 2000, at least relative to the S&P 500. That's pretty persistent. I mean, a lot of people thought that would fade after 3 or 4 sessions, and here we are now on day 14. That seems to be some real conviction that a lot of those small cap names might offer better value.
Yeah, potentially, and even international too, if you kind of want to broaden that out. Yeah. I think in general, investors are possibly looking for just players that are outside of the mega cap names that, again, may be more sensitive when it comes to valuations. And international small cap names have obviously gotten beaten down over the last 12 plus months. Again, not surprised to see that kind of rotation. I think in general too, there is a play of uncertainty, if you would, on U.S. policy, U.S. government fiscal policies, and all of that, which suggests that international type names are obviously getting the spotlight in this kind of market.
Well, when you talk about international equities, obviously that's a very broad church. So, I mean, specifically, are we talking about European equities? Are we talking about EM here?
I think it's a little bit of both. I think in general, you're probably seeing more developed markets doing a little bit better, relatively speaking. I'm a believer that, again, U.S. policy uncertainty here in the States have really sparked a rotation out of U.S. stocks to a degree. You're also seeing a little bit of an increase of European fiscal spending increasing as well. And so, again, relatively speaking, there is that natural gravitation, if you would, at least to a small degree at the moment, to move a little bit more offshore to hedge to a degree.
Yeah, absolutely. You think about some of the dynamics underway when it comes to Europe. As you mentioned, their increased fiscal spending. It's certainly an interesting time to be an investor there. But coming back to the U.S., I mean, talk to us a little bit about, you know, how you would expect monetary policy to interact with what we're going to see from corporate earnings. Of course, we're counting down to the January Fed decision, and then it's an open question what happens after that, both when it comes to the rate cutting trajectory, but also who is actually going to be leading the Fed.
Yeah, absolutely. It's a packed question. I think in general, the market is not expecting much action at next week's Fed meeting. And it probably is due to the fact that the latest economic data points, the jobs numbers in particular, have just been reasonably stable enough that it doesn't necessarily warrant another rate cut. In fact, if you look at Fed funds futures, there's probably not a lot of expectation of any rate cuts until possibly into June. And that kind of coincides to your question, Katie, about the next Fed. Who is that person to lead the central bank at the time? Certainly, it's also possible that Powell is holding the line until his term ends by May of this year as well. I think earnings, to your other question, is likely to remain in good shape for the remainder of this year into next year. We expect that the Mag 7 should grow earnings at about 22% over the next 12 months. And even the 493 names that, again, have underperformed last year, we do expect earnings to recuperate a little bit, about plus 10% over the next 12 months.
I am curious, Amy, about what some of your clients have been asking you, what they're most focused on. And also, is there a disparity in what you're seeing between your U.S.-based clients and those that are outside the U.S.?
Sure. I think a lot of clients have been obviously very emotionally attached to what's been happening on a policy standpoint. And that, you know, we certainly try to, you know, think through their sensitivity. And last year, as we've seen, diversification really paid off. And that is the message that we are sending again in this year. I think it is really important to think about the winners of last year, the mega cap names. But let's not forget, this is not the time to be forgetting the underperformers. And I think that strategy has certainly paid off. Not so much a distinction between U.S. and non-U.S. counterparts, to answer your question, Romaine. Again, the main questions that we have been fielding from clients is the AI party over, which we do not think so, although we expect intermissions from time to time. And we do think that there continues to be some tailwinds to support the economy, whether it's earnings power, as I've mentioned, Fed policy remaining supportive. Fiscal policy, too, to an extent, is supportive as we think about it for the remainder of this year. On the flip side, we know there are risks. Fed independence is one of that. We understand that tariffs remains a very fuzzy point at this stage. And we are obviously watching the labor market, which we know has been moderating.
All right, Amy, great to catch up with you.
Thank you.
Amy Kong is partner and wealth advisor over at Corient, kicking us off to the close here on this Thursday afternoon, a big day in the financial sector. We're going to get a temperature check of what's going on regional banks. Stephen Steinour, the CEO of Huntington Bankshares, he joins us on the heels of his company's latest results.
Then from public markets to private ones, a sit down with Mitchell Caplan, CEO of Willow Wealth and former CEO of E-Trade, on why he's saying that right now the private markets resemble the early days of online investing.
And longevity isn't just a market story, a conversation with designer Jonathan Adler about what's driven his success after almost 35 years in business.
The key to my success, and as much as I've had any, is trying to be singular, insular, and authentic, and being on a very peculiar and personal aesthetic journey.
the city of Minneapolis facing an economic slowdown as Target employees skip work over ICE raids in the company's hometown. Now, Target's outgoing CEO, Brian Cornell, set to meet with local faith leaders to discuss keeping federal agents out of Target locations. Let's bring in a man who's at the center of it all. Adam Duininck, he is CEO of the Minneapolis Downtown Council and a former city council member. Adam, it's great to have you with us. You think about what Target is contending with right now, its employees skipping work. Is this unique to Target, or are you seeing this across different types of businesses as well?
We're seeing it across a number of sectors. I think the restaurant industry and hospitality industry is probably leading the way in terms of kind of what we're seeing and hearing from. But a lot of companies are having this discussion of what are the impacts of ICE to our community. CEOs are having those discussions, the executives and their leadership teams talking to their employees about it, and certainly navigating the challenges with their shareholders and customers as well. It's been quite disruptive, and we're a city that's been through a lot in the last 5 years. And so as an association, we're just trying to do a bit of inventory, communicate, share information, figure out what the impacts are, and be a connecting point for our businesses with other decision makers.
Well, as I mentioned, I mean, you think about Target's outgoing CEO meeting with local faith leaders to try to keep federal agents, or at least discuss keeping federal agents out of their locations. What is your understanding of what CEOs are actually able to do in this moment when it comes to, keeping ICE out of stores or at least off the premises?
I mean, that's a question for some of those CEOs in terms of kind of what it is they can do, what it is they're able to do. I think the real challenge for them is managing the demands on their team, their employees, first and foremost, the challenges to their sectors, their industries. ICE disruption is one thing that has a huge impact on different sectors. There's employees that aren't coming into work. There are in certain industries, a lot fewer customers showing up to stores, either to come in to patronize a restaurant or to shop at a retailer. So all these impacts are swirling around in our city. And I think, business leaders are looking for the best place to have their voice. At times it's behind the scenes, talking with decision makers, elected officials, association leaders. At other times it's being a little bit more vocal in public. And so, they're all having a challenging time trying to navigate these truly are unprecedented times. This phrase unprecedented times gets bantered about quite a bit, but this is an unprecedented circumstance here in our city.
Can you put this in context too, Adam, with sort of what the city and more importantly, the downtown business district was sort of facing coming out of the pandemic, the efforts to sort of get people back into the city center, whether it's to work or to play, and whether what's going on now with the ICE raids and the associated protests, whether that has the potential to, I guess, permanently disrupt that progress?
Yeah, great question, and it's something that we're grappling with. And just to give some context to your viewers, the city of Minneapolis has been one of the lagging downtowns when it comes to return to office occupancy, and some of the metrics that we watch every day and every week. One of the areas in which we have done well is arts and entertainment, nightlife, and event attendance. That has continued to be strong in the last year or two. But this past year in 2025, we saw the largest increase in more in-office activity, more occupancy, more leasing activity. And now the activities of ICE being here and the challenges to the community, it really sets us up to continue to struggle in terms of kind of seeing that economic recovery. We were starting to see some momentum last year, and now January is off to, I think, a tougher start again for patronizing businesses, people being in the office, and some of those other things that we pay close attention to.
So what initiatives are you working on with the city council, the mayor, and maybe to a certain extent the governor, with regards to maybe getting more, not just businesses back into the city and more importantly to the center, but also more residents, people who are going to be there all day long, so to speak, or year round, so to speak, in a way that, the last couple of times I've been there, which was at the end, the middle of last year and the end of 2024, I stayed in that downtown area. It was kind of hopping for a little bit, but at a certain point at night, it just became a ghost town.
Yeah, that's one of the things that we spend a good amount of time on. Our residential population has grown significantly in the last 15 years. In fact, we have seen our residential population go from about 35,000, over 60,000 people living in our downtown core and over the last decade. And so efforts that we undertake to promote housing choice, incentives for that sort of development and construction to occur have been successful. Now we're looking at how do we retrofit some of the commercial spaces that aren't as successful, aren't as full. We're seeing less occupancy in those buildings. Working with both city and state officials on this policy. And the other thing we're working on is a program for our storefronts, because what we really do have is a challenging retail space, especially in the downtown core, where a lot of retailers have either, some of them left prior to the pandemic, and then the pandemic even accelerated that change in use as well. And so what small businesses can we entice? What are some programs that work there? We work on that. The city does as well. And we've had some success in seeing some improvement there as well in the last year.
With the larger companies and the larger employers, either in Minneapolis or really the greater Minneapolis, St. Paul area, so the United Health, the 3Ms, Best Buys, obviously Target, which we started off with, Cargill, I'm sure I'm forgetting a couple others. What conversations are you having with them? Are they contributing to this effort?
Absolutely, both with their engagement with the Downtown Council, the Minnesota Business Partnership, and is sort of the business roundtable group for the state. Very active participation in trying to bring back our downtown core and supporting the efforts that we put forward, as well as advocating for some of these policy changes. It's been how do we best support business climate initiatives as well. And so, I talked about some specific things around housing and storefronts, but really, I think some of the bigger challenges that we face as a state and as a city are those business climate, either heavy regulatory overreach in some cases, as well as a challenging tax climate, has made it harder for people to grow their businesses here. We've seen public employment growth, but we haven't seen that same private sector growth, and we're trying to think about ways in which we can incentivize that approach to the economy.
All right, Adam, well, we appreciate you taking time for us, and we want to catch up with you in the future and as things play out, and hopefully as they play out for the better. Adam Duininck is the CEO of the Minneapolis Downtown Council, also a former city council member here, taking a look at the local economy and how it's responding to some of the latest disruptions. When we come back, we turn back to financial markets, we turn back to chips, and we turn back to a big earnings report later tonight out of Intel. Seaport's Jay Goldberg joins us after the break, right here on The Close, right here on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. We start off with Alphabet. Raymond James upgrading to strong buy. The price target goes to 400 from 315 to analysts bullish, saying Alphabet and its Google business will be major benefactors of the AI narrative. Those shares up for a second straight day. Next up, Capri, the owner of Michael Kors and Versace. TD Cowen upgrading to buy. The price target up to 32 from 26. The firm says the upgrade reflects an improved price point strategy and progress on the Michael Kors turnaround. Those shares up for a second straight day. And finally, Texas Instruments. BNP Paribas raising the chip maker to neutral, the price target to 190 from 125. The analysts also upgrading Microchip and On Semi, saying sentiment on semis is improving. Shares of Texas Instruments, they're up for a second straight day. And those are some of our top calls. We do want to stay in the chip space as we await earnings out of Intel. The share is under pressure here on this day, but really that belies what has been a roughly 60% rally in the shares over the last 2 months. Joining us right now is Jay Goldberg, senior analyst over at Seaport Global, to get his thoughts here on what to expect. All right, I don't really know what I'm supposed to be looking for out of this report, Jay. Should I be paying attention to the normal metrics like revenue, margins, profitability, or should I pay more attention to what Laipply has to say about this company's future?
So I think the most important thing is going to be just revenue and their outlook for the quarter. One of the things I just upgraded them this week on this basic idea that they actually have products that people want to buy, right? Their chips are looking as good as they have been in years. They're on their own manufacturing process. So I think there's a lot of interest from the PC makers, from HP, Dell, Asus, those kinds of companies, like what they're seeing from Intel, and we should see that reflected in the top line in revenue.
But even
the other thing I'd look out for.
The
other thing I'd look out for is gross margins, right? That's the real critical one for me is can they make these new chips cost effectively? And that's going to be, I think, the more challenging side of this for the next few months.
Mm-hmm. Well, I do want to talk just about the reaction function of the market beyond what we're going to hear when it comes to the actual fundamentals of this company. I mean, I just had to double check the stat again because so far in 2026, Intel shares are higher by about 46%. That's after the stock rallied by 84% in 2025. It just seems like the expectations built into the stock price are so high at this point, Jay. I mean, can they deliver something that actually satisfies what's in the price?
Yeah, I think it's interesting. When I upgraded it this week, I looked at consensus, and consensus numbers haven't really moved that much over that time period. So I think the rally last year was very much driven about the question of, will Intel survive or not? That was all we were talking about last year. And then the government took a stake in it, and so I think those concerns went away. And I think now, for the first time in a while, we can start talking about just like looking at Intel as a normal company. Let's not worry about whether they're going to exist or not, all these big existential issues. Can they make good products? Are those products going to be bought by customers? And I think, I think I'm more optimistic about that than I used to be. And so yeah, I think there's a lot more upside to numbers here. There's certainly, if you get into the nitty-gritty of it, there's a lot of operating leverage that they could bring to play over the next few years as their fabs get back in line. So cautiously optimistic.
Yeah, and we're showing that ratio there. You're one of only 9 buys, 36 people straddling the middle line there at Hold J. And it gets to this idea, too, when we talk about where Intel fits into the broader AI story line, are they actually going to be a factor in that? And I don't mean so much as a competitor to NVIDIA, a competitor to that, but are they going to be sort of a primary place where people will go when they are trying to sort of build out their AI infrastructure? Can they be?
Yeah, so I think in terms of AI functionality and GPUs and accelerators and actually competing head-on-head with NVIDIA, that's a battle for another day. In the interim, the question is, will we need the chips that Intel makes, CPUs? Will we need those in AI? And I think most people have assumed that we don't, you just need NVIDIA. You just need CPUs. You don't need CPUs. You need GPUs. And I think I think that's a little bit off. We're going to need a lot of CPUs as we go forward, as we start moving into more use cases and more sort of inference workloads, as we say, with AI. People actually doing things with AI. We're going to need CPUs to do that, and I think Intel looks pretty competitive in that corner of it. So I think they're going to participate in this AI build out. Not as big as NVIDIA, but they'll have more than people expect.
All right, Jay, really appreciate the preview. That is Jay Goldberg. He is senior analyst over at Seaport Global. I am so excited for these results.
I am too. And also, I went on to Bloomberg Terminal because you were talking about how much the shares have rallied.
It's nuts.
But their last record high?
Tell me.
In the year 2000.
The year 2000?
Yes.
Wow.
$75 a share, roughly, back in August of 2000.
Well, we'll just have to see if they keep.
What's the record?
What's
the record? The longest stretch where a stock has gone without hitting a.
I don't know. Maybe ask Cisco about that. But coming up,
can I ask ChatGPT?
Huntington Bank. The stock is lower in the wake of their earnings release. We're going to speak with the CEO all about it next. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these markets, also keeping an eye on shares of Huntington Bank shares, having their biggest intraday drop since October. They reported fourth quarter earnings that fell a little bit short of analyst estimates, Romaine.
Yeah, and I mean, the numbers really weren't bad, but I think, you're kind of in this earnings environment where expectations are really high. But I always love these banks because in addition to obviously just the ebbs and flows of net interest income and all that other stuff, you get a better read here, I think, on economic conditions, particularly at the local level.
Yeah, and in different regions of the country. Yeah. So let's get right to it, because joining us for an exclusive interview, I'm pleased to say, is the chairman, president, and CEO of Huntington Bank Shares. His name is Stephen Steinour. Stephen, great to have you with us. So I want to start with expenses. I was taking a look at the transcript of your earnings call, and this definitely was a hot topic of conversations. Basically, you're anticipating core expenses to rise 10 to 11%. Explain the jump to us.
The expense base that we have this year has largely not included one of the combinations, one of our partnerships, an acquisition of a company called Veritex. And then in 2 weeks, there'll be another combination, a company called Cadence. So as we try to project full year earnings, it's a little messy right now in terms of an October close for Cadence versus an annual run rate, and a close to occur in a couple of weeks for Cadence. So we'll sort that out with the analysts and answer their questions. We gave them clear guidance on our EPS expectation for 27, our 26 efficiency ratio, our operating leverage. They'll be able to work it back, but we don't typically give exact numbers for any of our
our guidance elements.
Well, let's talk a little bit more about Veritex and Cadence, bring them into the fold. What does that mean in terms of your footprint when you think about different regions in the United States? What does that unlock for you?
Well, for 160 years, Huntington has largely been a Midwest bank. We have extensions into Colorado and the upper Midwest. But Veritex and Cadence position us very strongly in Texas and in the South. Now, we've expanded recently in North and South Carolina and certain other markets, but this is a big move for us. And we're thrilled. We've got great partners, outstanding executive teams and new colleagues coming to the company. These are both well-run banks, well-regarded, and we'll be able to bring a lot more product and capability to them. And part of the expense number reflects our intent to invest and to deliver our full capabilities, which at our scale are much greater than what either of those other two institutions could offer their customers.
I am curious.
So we'll build out.
Okay. I am curious, Stephen, at least with regards to commercial lending, business lending here, are you seeing more competition in that space, not so much from other banks, but other, I guess, non-bank companies, if you will?
Right. Well, there's been non-bank financials coming into this space now for close to a dozen years on a gradual basis. It's accelerated recently. We see some of it, but we're very large, we're very diversified, and we've been making investments since 2023 when Silicon Valley had its issues. That was a moment of investment and growth for us. We were atypical to our regional peers, and we've added a lot of capacity. We've added positions and teams. North, South Carolina, the two combinations I referenced earlier, 8 new states. So we just have a core dynamic that's very strong. We're growing in every market. Plus, we have the investments and the opportunities from these investments.
How's the consumer holding up right now, Stephen, particularly when it comes to loan growth for your business? Are they still borrowing? And 2, more importantly, when those folks are coming in the door looking for loans, is the quality of that borrower still up to snuff?
Well, our credit policies haven't changed whatsoever in the last number of years. So we are still quite active in our lending, but it's a K-shaped situation. And so I really feel the low, moderate income households are challenged. They've been multiple years of higher inflation, and wages have not kept up. So there's a squeeze going in at that level. But sort of mass affluent and above generally are performing in line with expectations. Auto had a pretty good year in 25, expected to do reasonably the same in 26. Generally, the business customers we have, 500,000 small businesses, they're generally doing okay. Not great, not like the go-go years, but good.
Yeah, and to your point, I mean, it's definitely been an uneven economy out there. I do want to talk about what some of your priorities are in 2026, because you've got a lot on the boil. We talked about Veritex, we talked about Cadence, bringing those into the fold, expanding your footprint. What would you say is your top priority as you get deeper into this year?
Our top priority hasn't changed. It's grow the core. Organic growth is what we're looking to achieve. We've had outstanding growth now for 3 years. We're starting this quarter very strong, equivalent to where we were last year, and we're optimistic about how the year sets up. We do a lot of equipment finance. We do a lot of business with small, medium-sized businesses, and then we have these 15 specialty verticals that do business nationally. So we're the 4th or 5th largest equipment finance company in the country. As onshoring, reshoring, as robotics and other automation have been pursued, that's all great business for us. So we have a very diversified portfolio. It looks like we're hitting on all cylinders as we come into this year.
All right, Stephen. Well, always great to catch up with you. Everything I think you said there really gives a nice sort of read, not only on your business, but certainly on a certain segment of the economy. Stephen Steinour is the chairman, president, and CEO over at Huntington Bancshares. As we continue to march to the closing bells, we shift focus and take a look at the bond market. A bit of a breather after a couple of volatile days. The conversation up ahead with Stephen Laipply over at Blackrock. Stick with us. This is Bloomberg. It's been a volatile couple of days for U.S. Treasuries, but they're letting off some steam in today's session. Solid economic data here in the U.S., including better than expected GDP for the 3rd quarter, a revision, and well, better than expected personal spending numbers, but that is offset by still some concerns about inflation and trade. Joining us right now to break it all down is Stephen Laipply. He's global co-head of iShares fixed income ETFs over at Blackrock. Stephen, great to see you here.
Great to see you.
Let's talk about kind of the tactical trades that we've been seeing in the Treasury space here. Is this more conviction, or I say conviction, but is this more a bet on economic conditions, or is this more a bet I guess, on some of the geopolitics and the chaos, if you will, that has kind of upended markets?
Well, the last couple of days have obviously been triggered. The volatility has been triggered by the JGB sell-off, some of the headlines that we saw coming out of Europe. But if you look since the end of the year, break-evens have leaked wider. I think the data, though, coming in today kind of reinforces that inflation seems to be contained. Growth is still solid. The one concern that I think might keep Treasuries sort of in check would be labor market continues to show some softening, and so there are some countervailing forces there. But the slowdown in the labor market is something that's definitely containing that.
What did you make of the sell-off that we saw in Japan? Because I've heard from a lot of folks saying that honestly this is just kind of a natural function of reflation, which of course the country is going through.
There's that, and there was probably a technical element as well. I mean, you have to look at the liquidity on different parts of the curve, but I think some of it was, maybe thinner liquidity further out, but it was certainly reflation's part of it. But yeah, there was probably a technical dimension to that as well.
Let's talk specifically about ETFs and where money is moving when it comes to fixed income ETFs. I'm taking a look at the leaderboard for overall fixed income ETFs in 2026, and it's only the 22nd. But that being said, you take a look at what is losing money right now. LQD leading with about $3 billion in outflows. That is investment grade bonds. HYG, that is junk rated companies. That has about $2 billion in outflows. And I mean, both of these funds took in money last year, but what does that signal to you? What are you seeing when it comes to appetite and sentiment around the corporate credit markets?
Those two tickers in particular do have a lot of volatility in the flows. And so when I look at the broader suite, we are still seeing some mild inflows in investment grade and high yield away from those. But those are what we call financial instruments. So think of them very much alongside of futures as an example. They're traded a lot for hedging purposes, et cetera. So I don't know that we can yet say that outflows in LQD or HYG, imply any sort of a major rotation because it's sort of mixed elsewhere.
It's a fair point that for a lot of folks, like, these are liquidity tools.
Yes,
you use them to get in, get out, get that quick exposure. But I'm going to ask you a question that I've been asking you for years, and that is the demand that we're seeing for the front end of the curve, specifically for cash. That has been sort of the defining feature underneath the surface of all these record highs that we're seeing in the equity market. Do you think that 2026 is the year where we finally see investors start to step out the yield curve?
Well, we've been looking for that for a while, but last year, SGov, our T-bill fund, took in around $40 billion. So, yeah, it was a very, very powerful flow. So we will see. We're still seeing positive flows this year. I think people are looking for, some sort of an anchor at the front end, flight to safety, if you will. But then we're also seeing flows further out the curve. So it's not quite the story that it's all in SGov. I mean, it's reasonably balanced further out. So as another example, our broadest Treasury fund has taken in a fair amount of flows, GOVT as well. So it's starting to move. We've been saying for quite a while, the belly of the curve is a reasonable place to be to balance income versus duration.
What are you seeing with regards to people taking any sort of inflation protection? Is that still a thing? Are people getting more concerned, less concerned?
The flows would say that it's really died down. I think more or less those flows have been sort of flat to down. We don't really see a huge amount of inquiry on it. But I do think, a multi-sector portfolio should have some element of that. A product that we just launched with Bloomberg, BTOT, is the first
great company, by the way.
Yeah, the first multi-sector fund that does include things like inflation and bank loans. But the reason is because we do think for a multi-sector broad portfolio, you should still retain some element of inflation protection.
Right. Well, we only have a minute left, and I have an existential question for you. And that is, if you're investing in fixed income right now, what are you investing for? Are you investing for the hedge-like properties, which have been kind of unreliable over the past few years, or is it purely at this point just an income play?
Income's going to dominate, and so that's why we've been talking about sort of that intermediate part of the curve, because further out the curve, there are long-term concerns about term premium. What's the fiscal balance look like, as we keep moving out, and as the spending picture is somewhat volatile, right, depending on legislation that's going to pass. So primarily income. I would say, though, if you did look at last year, the diversification did come back. Of course, anything that's going to be based on any sort of hawkish Fed sentiment or any upward pressure in inflation is going to go against that. But it has actually rebounded, the diversification, and ballast part of it.
All right, Stephen, it's great to see you.
Great to see you all. Thank you.
That is Stephen Laipply. He is global co-head of iShares fixed income ETFs over at Blackrock. And from fixed income, we go back to those equity markets. We're going to take you to the closing bell with Anastasia Amoroso. She is managing director and chief investment strategist over at the Partners Group. This is The Close on Bloomberg.
You are seeing a rotation out of the big winners from last year. And so these other tech companies, small cap, mid cap, even the 493 names in the S&P 500 are seeing a relative boost on a year-to-date basis. Not surprised, right? If you look at the mega cap winners from last year, they have been the winners, the dominant players for such an extended period of time. A rotation like this is absolutely not a surprise.
That rotation trade still in effect, with the Russell 2000 outperforming the S&P once again by a much smaller margin than past sessions, but still sticking. Amy Kong kicked us off to the close just about 50 minutes ago. Romaine Bostick alongside Katie Greifeld.
Yeah, it's going to be interesting to see how we end up. The S&P 500, it's still in the green. Off session highs, though, when it comes to the big index there.
It was 6909.99.
Yeah, that's...
You don't get excited for those almost.
No, not until we get to 7,000. Then I'll throw a party. But you can see that tech is outperforming today. Of course, a lot of this hangs on what happens after the market close in terms of forward sentiment. The chip name's not doing too hot today, but we do get Intel in just a couple of minutes.
Yeah, that could actually be somewhat consequential for the market. Obviously not a big weighting in any of the indices, but symbolically, certainly another read here on the AI trade. Our next guest says there's actually a lot more places to invest if you're looking. Anastasia Amoroso is Managing Director and Chief Investment Strategist at Partners Group. She joins us here in Studio 2. Great to have you here.
Good to see you.
Before we talk about some of those opportunities, I do want to just kind of get your take of some of the volatility we saw over the last few sessions. Sure. Geopolitics, as we have learned, are still here. They still have the ability to rattle markets. I am curious as to how you sort of take some of these short-term disruptions and I guess, I don't know if ignore is the right way, but find a way to sort of ride them out for your long-term goals.
Well, maybe the best way to think about it, it is a feature to this market and not a bug. The volatility is going to be with us periodically, and especially in a year or in the next 3 years of this administration. The volatility, for example, was elevated during the last 4 years of the same administration. So, again, it is a feature. The other reason why I would say, is it a feature of this market is because we have come into the year, Katie, not quite at 7,000, but pretty close to it. So I call it investing at high altitude, at elevated, valuations and tight credit spreads. And when you have this sort of setup, you expect when something unexpected comes in, you have to price it in because you haven't. And so that's what really causes the volatility. But again, you have to kind of parse through, does it change the fundamental outlook for U.S. equities? Does it change the fundamental outlook for earnings, for the growth of the U.S. economy? And a lot of what's happened this year, whether it's the developments in Venezuela, whether it's what we've seen, just now with Greenland, it does not actually alter the trajectory of U.S. corporate earnings.
So when it comes to looking for investment opportunities, whether it's in public or private markets, where are you seeing the better opportunities?
Yeah. I mean, I think what's really interesting is the predominant theme for the last couple of years has been AI, and more AI. And look, we're still fully invested in that across a spectrum of opportunities, and I think everybody should be. But at the same time, there's a lot more themes that I think could be sustainable this year. First of all, we can talk about the U.S. consumer and whether it's the housing angle, whether it's just the more disposable income and really cash being returned back to the consumer, that propels all kinds of discretionary spending. So I think that's one sector that you could look at. The other sector that we certainly are looking at in private markets especially is the defense sector. it has been an emerging topic, and it's really, really important. Look, I know
when you say defense, in the U.S. or globally?
Really globally. It is a global phenomenon, and of course we know the European companies and countries are beefing up their defense spending, so is the U.S., and by the way, Asia has as well. So it is truly a global phenomenon. And look, I know that in the public markets, if you look at some of the defense stocks, they're up 18, 19% year to date after a very strong performance over the last couple of years. But I still don't think the full opportunity of defense is priced in, and certainly also not in private markets, because we're going to need something like over $1 trillion in additional defense spending across NATO over the next 10 years if we were to reach those goals. And I think this intent of countries is really strong. So in private markets, we're not investing in some of those publicly traded defense names, obviously, but we're looking at the components, the subcomponents, the supply chains that are mission critical to building some of that equipment.
That's really interesting. I was going to ask you, what is the profile of a defense company that's in the private markets? And to your point, it sounds like it's more the supply chain elements, which I guess eventually work their way into some of those public companies.
That's right. That's right. They do. And, obviously where we can find a mission critical supply chain or a component that maybe is not only used for military use, but also can be used for civilian application, that really allows, a company to have a more sustained, let's say, earnings profile. So there's lots to do there on the defense side. And then I would say energy is kind of interesting this year as well. And, I think the oil sector is a tough place to be, because if we do succeed at boosting Venezuelan oil production, we're ultimately going to depress the domestic oil price. But I think what's actually happened is this realization that oil and energy is a strategic asset. It has strategic importance, and we have to prioritize that. So that does make energy as a whole a bit more investable. For us, we're not leaning into oil by any means, but we're looking into natural gas, the lower carbon fuels required to produce the electricity to power, back to the AI trade, those data centers.
Well, you make an interesting point that you think about the energy sector. I feel like it's just been so underloved for so many years. And to your point that it might be becoming a bit more investable. Does that mean you're going to see more of, the tourist crowd, if you want to call them that, come into this sector and actually recognize it as maybe this is somewhere where I should be putting my money?
I think so. I think there's going to be more generalist investor interest in the sector. And, look, I think if you look at the oil and gas integrated type companies, will they commit to investing in Venezuela? Will they have the CapEx and the payoff on that CapEx? I think that's, that's really tough to game out. And also if that results in lower prices, that's not necessarily a great profile. But investors are clearly honing in on the opportunity, which is the oil services companies and the Halliburtons, the Schlumbergers that will be involved in building up the infrastructure. So I think that's where you'll see some of that interest. The refiners that may have access to cheaper Venezuelan heavy crude oil over time, I should say, that's also of interest. But I do think that's more of a trade in public markets. In private markets, again, we would focus on the nat gas infrastructure build out. I think that is really sustainable for what we need to achieve with energy in the U.S.
All right, Anastasia, and speaking of natural gas, it's cold outside. Katie.
I know.
That's been on fire the last couple of days. Anastasia, always a pleasure.
Great to see you.
Anastasia Amoroso, Managing Director, Chief Investment Strategist at Partners Group, counting us down to the closing bell. It's just about 2.5 minutes away. Stocks off session highs, but nowhere near their lows. 0.5% gain right now, Katie, on the S&P 500.
I do want to point out that it's early, but year-to-date energy is your top-performing sector of the 11 in the S&P 500, higher by about 9.4%. So.
Absolutely, yeah. And I mean, we've seen a lot of people gravitate to that space, not only because of the traditional energy sector, but the idea of obviously the AI build out and all the needs for that. There was a great interview with Kathy Wood earlier here talking about the potential of nuclear as we move closer to those closing bells. A full breakdown of all of today's market action and a push ahead to earnings out of Intel starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. Carol Masser and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Another interesting day on Wall Street. And in just a few minutes, it might get even more interesting. Earnings scheduled to drop from Intel.
Yeah, which makes me think about that one. I mean, it's little change in today's session. Keep in mind, it's been on quite a run this year, last year. I mean, it gained nearly 12% in yesterday's session. Even the SOX, which has been on a bit of a run, very mellow in today's trade, underperformance. So we'll see what we get from Intel. The expectations, certainly based on that run, I would say are pretty high.
We're also seeing that rotation into small caps continue. The Russell 2000 again outperforming, Katie, the S&P 500 today for a 14th day in a row.
Yeah, we've been keeping a close eye on what's going on with those small caps. What exactly the fundamental story is, again, I'm not quite sure. We've had this conversation before.
I do want to, well, speaking of fundamentals, I do just want to kind of touch back on Intel because we talk about a company. We should point out expectations are for revenue to be down, but the idea is that that slowdown in revenue is actually slowing itself. Remember, on an annual basis, this is a company that saw revenue drop in 2022, 2023, 2024, and it's going to be again in 2025 unless they surprise us in a couple of minutes. But the big expectation right now is what does 2026 look like? Analysts are pricing in a return to revenue growth. Are they going to meet those expectations?
Yeah, exactly. So these are things that we're looking at. I'm just looking at, Intel, I think, actually having, is it a bigger market cap than TSM? I'm going to look this up.
Yeah, look that up here as we walk through the numbers here. Green across the screen, though, a little bit more subdued than the gains that we saw yesterday. The Dow up 0.6%. The S&P up 0.5%. The NASDAQ Composite up 0.9%. And the Russell 2000 closes out the day higher by about 0.8% on the day.
All right, just going to the S&P 500, folks. Taking a quick look here, and you're seeing kind of an even split here. You've got about 285 names to the to the upside, excuse me, 214 to the downside, and you've got 4 unchanged.
Let's take a look at the sectors as well. Not quite an even split. You do have 7 sectors in the green, 4 rather, finishing in the red. In terms of what outperformed today, communication services was your big winner. You also had consumer discretionary show up. So too did tech. In terms of what didn't have so great of a Thursday, real estate down by more than 1%, utilities, industrials, and consumer staples as well.
All right, guys, let's get to some of the individual gainers as we await earnings. And I'm going to start with ARM Holding. Chips, though, certainly have been on our mind. ARM Holdings, though, you saw that one gain as much as 8.5% intraday at its highs.
Yeah, I've got to interrupt you now here, Carol. My apologies here. Intel earnings crossing the wire right now. Let's go straight to the revenue forecast. For the first quarter, the company says adjusted EPS will be 0. The street was looking for 8 cents a share. As for the revenue side, the company says revenue for the first quarter, the quarter that we're in right now, $11.7 to $12.7 billion. The street was looking on average for $12.6 billion. So the top end of that range is right around what the street was looking for. But of course, it's a wide range of about $1 billion here. That might be why you're seeing some softness in the shares. As for the quarter that just passed, the fourth quarter revenue did beat $13.67 billion. Adjusted operating margin did beat 8.8%. Adjusted EPS also beat at 15 cents a share. The street was looking, guys, for 8.7.
Yeah, that's the thing. You can see shares actually pairing their decline right now, down about 1.3%, but it's volatile out there. I mean, Romaine makes a good point that the look back, when it comes to the fourth quarter, they actually beat there when it comes to the adjusted EPS, but certainly that first quarter outlook, Tim, is going to be disappointing for a stock that, as Carol said, has had quite the run up.
Yeah, down 4% in the after hours. I'm going through the press release and looking at commentary from Intel's CEO, Laipply, who says our conviction in the essential role of CPUs in the AI era continues to grow. He continues to say our priorities are clear: sharpen execution, reinvigorate engineering excellence, and fully capitalize on the vast opportunity AI presents across all of our businesses. Intel shares in the after hours bouncing around a little bit, but down about 4.8%.
Just going to layer some commentary from the CFO, Dave Zinsner, also on Intel, saying it sees the lowest available supply in the first quarter before improving in the second quarter and beyond. So we have seen this with a lot of the players in the chip sector. The demand is there, but the supply, they're not able to meet it.
You know, it's kind of interesting. We were speaking with Jay Goldberg over at Seaport earlier today. He's actually relatively bullish on Intel. We should point out this is a stock that has something like 36 holds, something like 7 or 8 sells. There's only 9 analysts out there on the street that have a buy, and Jay is one of them. And he actually thinks that they can actually start to ramp up production on some of these chips. His biggest concern was whether they can do that in a cost-effective way. He said he's going to be really laser focused on what this company has to say on the conference call about those costs going forward.
It was also interesting to hear him explain why we saw such a huge surge in Intel last year. The question was whether Intel was going to be able to continue to exist. Of course, now it has the Trump administration's backing. The Trump administration does have a stake in this company. So
you have a stake in this company. Romaine has a stake in this company. We own 10% of this company as Americans.
Yes.
I think you bring up a really good point. So is this the U.S. backing trade, or fundamentally, is this company getting on a better trajectory? And I think that's where we've got to kind of watch and see what else commentary we get from this company. And is it, able to stick around for a long time?
I think so. Yeah, and it'll be interesting how they address that on the conference call. And I think it's kind of, the answer to your question, it's kind of yes and yes, right? This is still about basic, good old-fashioned corporate fundamentals, but also like its place in the AI space. Does that relationship with the U.S., that 10% stake, and whatever sort of things the White House can use their bully pulpit for to sort of help this company build out, does that become the fundamental story? I don't know.
I also want to point out its foundry revenue. Excited to get more color there. Foundry revenue coming in the fourth quarter, $4.51 billion. The estimate had actually been for $4.36 billion. So actually a bit of a surprise there. The big question is, what does the customer acquisition strategy look like? Are they adding new clients there? One of the big fundamental questions about Intel at this juncture and their place, to Romaine's point, in this AI space.
Just to reiterate some headlines as we watch, Intel shares down about 5% in the after hours. The company says it's making good progress in 14A production. Laipply says production yield's not up to his standards, and the CEO says chipmaker missed a lot of opportunities and says they can't get enough supply to meet orders, though demand is quite strong.
All right, guys, let's go to Capital One Financial, also reporting its earnings after the closing bell. And you've got a couple of headlines, but let's get to one from the Wall Street Journal that it is planning to buy Brex for $5.15 billion in a cash and stock deal. So some movement within another banking company in terms of an acquisition, a pretty sizable one, if you will. The stock right now,
that's a big deal.
Down about 2.6%. So again, confirming that pact. And I'm just going to kind of do a quick look at fourth quarter adjusted. Go.
Sorry, but I just want to say on the Brex deal, because that's a big deal, because we've been talking a lot about these credit card, potential caps on credit card rate fees. And Brex is, this is basically rewards and kind of everything not really fee related, or at least that's their sort of bread and butter, the technology and the rewards that go along with it. So it's kind of interesting to see Capital One leaning deeper into that reward space.
Yeah, I'm looking at the Wall Street Journal write-up of this. Brex oversees close to $13 billion in deposits held at partner banks and money market funds. The acquisition is expected to close in the second quarter of this year. Brex's CEO will plan to continue in the role after this deal closes. Capital One Financial shares down in the after hours by about 4.3%.
All right, folks, back to Intel we go, because we've seen this one kicking around in the aftermarket. Again, the headline, the company giving a lackluster forecast for the current quarter, talking about supply shortages are making it harder to meet customer demand. So once again, a disappointment for investors who kind of were looking for more of a boost from new products. And you can see Intel shares, they are just trading down about 3% here in the aftermarket. And keep in mind, this has been a top performer among the semiconductor names over the last year or so. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romaine, of course, continuing there on the close on TV. Tim and I continuing on BW Daily right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
Our coverage continues of those earnings out of Intel. Fourth quarter revenue down about 4.1%, profit of 15 cents a share. Guidance going forward on both the revenue side and the profit side looks a little bit light to the touch here. A lackluster forecast due to what the company says are supply shortages making it harder to meet customer demand. Ed Ludlow just getting off the phone, I believe, right now with the CEO, Laipply. He joins us right now. Ed, what did you just have to say?
Well, supply issues that Intel can control. So the way that Laipply explained it is that in the fourth quarter gone, the demand was there. But to meet demand, they had to clear out inventories. And he made an admission, essentially, that in the current period, yields, production volumes have not been to the standards that he wants to hold Intel. So that is the issue at hand. They are having execution problems, internal wafer supply, to meet what he keeps talking up as being robust demand. And you're exactly right that, at the midpoint, the forecast is below what the street was talking about. But particularly in data center, the story intact that they are benefiting from the necessity of having CPU, even if the world is very focused on NVIDIA's GPUs. It's just Intel's not doing a very good a job of getting it out there to the marketplace.
Yeah, definitely, and that was in the commentary as well, that conviction in CPUs. Talk to us a little bit about what we're seeing in their foundry business. In the fourth quarter, actually, revenue a little bit better than expectations. Looking out into 2026, what does it look like in terms of their customer base and potentially adding new ones?
Yeah, look, the street and the industry is waiting for Intel to tell us something of substance about the 14A process. And again, like Laipply was very disciplined. He basically said until he has volume commitments from a customer he can name, he's not going to go about the exercise of ramping the relevant foundries to support that. They are engaged with multiple customers who are working with Intel's teams on the engineering and IP sharing for the 14A process. But for now, it's not real. And he was candid in the interview that, like, I'm not going to tell you, yes, this customer is real, because it's not there yet. But everyone's waiting for that because you guys were talking about the US ownership of this stock prior to the break, right? And the idea is that that is the direction of travel for this country. They are looking for a national champion to onshore chip manufacturing, not for Intel as its own customer, but for third parties. We don't have any names, and that would have been something that moved the needle for the street. The stock continues to bounce around, now back down 5% in the after hours.
All right, Ed, really appreciate your reporting. That is Bloomberg Tech co-host Ed Ludlow, fresh off of his interview with the CEO of Intel. And let's keep the conversation going now with Matt Bryson. He is Managing Director of Equity Research over at Wedbush Securities, covering the hardware sector. He has a neutral rating on shares of Intel with a 12-month price target of $30. Matt, great to have you with us. So you take a look at the initial reaction in shares, down about 5% after hours. A lot of disappointment, I would say, at this point when it comes to that weak forecast, when it comes to some of those supply issues. What do you make of this print?
No, I agree with you. I think there's been a whole lot of optimism around Intel potentially turning a corner. You have their new 18A products out, and that really is going to define what Intel looks like moving forward. Do they get these new process nodes to work? And hearing that yields are difficult, right? That's not a great start to 18A.
And, I'm taking a look at your notes heading into this report, and you had a lot of concern when it comes to PC demand, and also what is their share when it comes to the PC market, PCs and servers. I mean, taking a look through the details here, and I know you've only had a couple of minutes, do you feel better about some of those risks, or, is some of that concern justified by this?
So it's a little bit hard to tell. When Intel tells you that they're really supply constrained, you don't know with their guide, how much is the disappointment on the top line? Is it their inability to fulfill demand, or is it rather just demand has dipped? Having said that, I think when you're thinking about Q1 and heading into next year, assuming that they are indeed supply constrained, then the real winner is AMD, right? They're the ones who are filling demand, and I completely believe that server compute demand is really strong and that AMD is taking share there.
I am curious, though, too, about just as Laipply really tries to sort of turn this company around, there's always that idea of the bridge between whatever this AI future might be and obviously the legacy business. When you look at their core business, which is still their biggest business, basically the PC business, client computing, that was down 7%. So that's basically performing worse than the other parts of the business. And I am curious as to whether that ends up becoming a more meaningful drag on his ambitions to pivot this company deeper into data centers and AI.
I think the CCG business, assuming that you're competing, it should at least be a steady business, right? No one's need for PCs, at least at this point, is going away. And there's only two competitors. So particularly if you're able to build a good chip in-house, you should have some cost advantages versus AMD. And so I don't think that's so much a drag. I think the concern is just, can you compete in that business? Can you compete in the server business? And if you get those right, then you have some advantages addressing AI, particularly owning your own foundry, but they're not there yet competing on their core businesses.
Well, also, but to that too, as well. I mean, with regards to the PC business, I understand. Look, there is a sort of cycle there that is rigid. There's also obviously less competition in this space. Also, costs are going up. I don't know exactly what the cost of memory is right now, but I know what the share prices of SanDisk, Western Digital, and all these companies have done. And so I think to my head, what are they going to have to pay to actually get those? Certainly not they, but what are PCs really going to cost when you are going to the store and looking for something new over the next few months?
And I agree with you completely. The CCG portion of business, at least my numbers in Q4, it was north of 60%. And that, again, stepping back to, is it a supply problem? Is it a demand problem? I think moving forward, you potentially have this demand issue on the PC side because, as you said, memory prices are going to weigh on what PCs cost, and that is going to inhibit consumer purchases.
And Matt, I do want to talk about valuations when it comes to Intel a little bit. The conversation this year has been the fact that so far in the early days of 2026, these shares are higher by more than 40%, and that's coming after a year where obviously they were on fire in 2025. As an analyst, how do you sort of think about that and weigh it against the fact that the U.S. government does have a 10% stake in this company as backstop of sorts?
Yeah, so it's hard. So when I think about semiconductors in general, if I think about Intel, historically moving back 3-4 years, they were trading low teens multiple. So you would need something like, let's call it $4 in earnings to justify $50 type price. Semiconductor multiples have gone up. So when I look at the cheaper names in my space, they're like 20 times. And so at that point, you're looking at 250. And part of the reason I'm on the fence is I just don't see a path yet to that type of earnings number that's clear. Of course, if they get 18A right, then you start to see that path. But I just don't see it yet. At the same time, it's really hard to be negative on this name, given all this news flow and how much it's moved the stock.
And that gets to the idea, too, Matt. We were speaking with one of our colleagues before you. The idea of the government having this 10% stake in the company and the idea that, well, yes, we know fundamentals, all that matters. But, for the most part, you have the world's largest economy, the government of the world's largest economy, basically saying, look, we have a vested interest in seeing this company survive and thrive.
You're certainly right. And I think in part that creates the probability that you continue to see the U.S. government invest in Intel. You see other companies looking to stay on the good side of this administration, invest in Intel. And that's all good for Intel. I guess the question, though, is still, you saw Pat Gelsinger put a lot of money into trying to restore Intel to competitiveness with TSM, with AMD, and it just didn't work. And so in part, it's the funding. In part, though, it's also getting the right recipe. And what we saw during Pat's tenure was it takes 2-3 years before you have any idea of what the influence of the new exec is. And so I think we should give Laipply a lot of time to figure out around where Intel's going. But I also think it's going to take a lot of time. When we talk about 14A, those products are really end of this decade. And so that's part of the problem for me, is it's just such a long time period.
All right, Matt, always appreciate you jumping on for us. Great insights. Matt Bryson, Managing Director of Equity Research at Wedbush Securities, which pointed out shares of Intel just around session lows, after market lows, I should say, here, down about 7% here. Be interesting, that conference call starting in about 43 minutes time. Now, we do have some other earnings, Kitty, that crossed the wire. I want to get to CSX. It's actually one of the biggest gainers to the upside in the post-market trade. The railroad operator posting adjusted EPS. It actually missed. It was 39 cents a share. Street was looking for 41 cents a share. Similar story on the revenue side here. But going forward here, the company seems to be giving investors a little bit more faith here that we could see a rebound, particularly when it comes to some of their agricultural and minerals revenue business. Also, the intermodal business continues to shine up about 7% year over year.
Yeah, the CEO also saying in the statement that basically their quarterly results reflect first the subdued industrial demand environment, also actions that they've taken to adjust their cost structure. So focus on costs. Let's talk quickly about Alcoa as well, higher by about 4.4%. When it comes to the fourth quarter, they beat when it comes to adjusted EPS pretty mightily there, $1.26 versus the estimate for $1 and just 4 cents remaining.
Absolutely. I remember the old days when like Alcoa was the very first company to report in the earnings season. It was kind of like the hallmark there.
When was that?
Before. Okay, I'm not giving away my age. Anyway, we're going to continue here our coverage of earnings. Capital One down about 4% here. The earnings are out, but so too is big news here on a big acquisition. That conversation coming up next here on Bloomberg. All right, taking a look at shares at Capital One, down about 5% in the after-hours trade. It just reported earnings and missed when it comes to adjusted EPS, $3.86 a share. The street was looking for $4.15, charge-offs at 3.83. That's a little bit better than expected. A net interest margin at 8.26, roughly in line with estimates. The company also saying that it will buy Brex. It's a fintech firm. It's about $5.15 billion. About half of that is going to be in cash, the other half in stock. Maybe that's why you're seeing a little pressure there on the shares. Stephen Biggar joins us right now, Director of Financial Services Research over at Argus. All right, Stephen, let's first start off with the fundamentals that we learned in the most recent quarter. Net revenue was still up 53% here, but it looks like on the cost side, and particularly on the credit loss side here, there were some concerns there. What was your first reaction?
Yeah, good afternoon. I think the slight miss here is some addition to the lost reserves for the quarter and kind of getting, I think, in shape for 2026 here. So that's probably part of it. Loan growth a little bit tepid, considering that we expected a little higher growth on the credit card side in particular, so that we'll have to take a further look at that. As you said, I think the stock reaction is probably in part a bit of that miss as the net charge-offs have to be accounted for and get some greater loss provisions in there, but also the Brex acquisition, which partly in shares is always a little bit of uncertainty there. I think we'll hear much more of that obviously on the conference call at 5.
So when we start to talk about kind of what the future of this company is, and I know you haven't had a whole lot of time to look at this Brex deal, but when we talk about sort of adding in a company like that, much more focus on rewards and a lot of course, the underlying technology, how does that sort of fit in with Capital One, particularly coming off the heels of that last big acquisition that they just did?
Well, I think clearly Discover was an enormous addition, right? About 40% to Capital One. So busy integrating that as well, but. If you think about some of these fintech firms and their ability to add, as you said, rewards or more corporate cards, whether it's business banking, spend management, things like that Brex is known for. So I think that is, a pretty nice addition here. We'll learn more about the expectations on synergies there as well. But clearly, a lot that can be done or is overlapped in the credit card space with this Brex addition.
Well, let's talk a little bit more about, where they stand when it comes to corporate clients. That, according to reporting by the Wall Street Journal, is one of the big motivations to buy Brex. We know that that's a crowded, a competitive space. What do Capital One's inroads look like there?
Well, you're right. Mostly Capital One is more of a retail or considered more of a retail type lender. Credit cards are, still 70% plus of the business and loans outstanding there. They have channels, obviously, with auto lending and personal lending as well. They work with a lot of, affiliates and auto lending and in particular RV, that sort of thing. So, there are opportunities there, and I think they're looking to gain a little bit of share now that they certainly have much larger size with that Discover acquisition, and I think they're looking kind of at the next level of growth and where they can pick up market share and do so competitively. They are very competitive on the credit card side. They're very competitive on the retail banking side in particular. The only kind of major bank that has an offering with kind of no frills, no maintenance charges, fees, that sort of thing for the average consumer in terms of banking. So it is and could be they could be a threat in the corporate space.
Well, speaking of threats, let's talk about the overhang over this earnings release, and that is President Trump's proposed cap, that 10% cap on credit card rates. Of course, there's a lot of questions about whether or not that will go through, whether or not that will be implemented, and what that looks like. But the direction of travel that the administration seems to be going in, what does that mean for a company like Capital One and some of its peers?
Well, clearly the stock has taken a hit, and that's a big part of it, if not all of it, from the more recent highs. This would be a significant move. Clearly, this 10% rate cap, and I can't say that it's an enormous surprise, right? Candidate Trump talked about this on the campaign trail. It had been a pledge, and in fact, we had 2 senators introduce legislation back in February last year around this exactly. And I don't think it's gotten a lot of traction. I think the industry is going to be very vocal in fighting this. You really just you can't mess with banks' ability to price risk in this way by only moving just this one equation, right? One part of the equation in terms of interest rates. So I think the end result would end up being reduced credit availability, which is really a disservice for consumers.
Yeah.
It could put the financial system at risk if they're not able to price for it.
All right, Stephen, great to get some time with you. That is Stephen Biggar. He is Director of Financial Services Research over at Argus. Shares down about 3.3%. Not the only company making news right now.
Yeah, absolutely. Looking at Disney right now, a proxy filing with the company setting its annual meeting for March 18th, but more importantly, reiterating its plan to name a new CEO in early 2026 to replace Bob Iger, who, of course, return to the job after first leaving it in 2020. Of course, he's been back there since, roughly 2022 now. And they promised that they would have something for us in about 3 years' time, and looks like we're there.
Yeah, that plan to name that new CEO in early 2026, I suppose that means sometime before June. So
is it going to be you?
I don't think so, unless things get dramatically different. But in any case, coming up, more on credit cards as Bank of America and Citigroup weigh new cards that would have President Trump's desired 10% rate. We'll discuss all of it next. This is The Close on Bloomberg.
If you actually make this a policy, it can reallocate credit. That will slow down spending. It will slow down credit availability, and that might not be what you're trying to achieve. So can you do something on a go-forward basis, on unlimited things? And even 1 year, if you had to go reshuffle the whole deck, that would be pretty interesting and to cause a lot of change in people's views of what they have available for credit. And you want people to have available for credit because that gives them the courage to spend it.
Bank of America CEO Brian Moynihan out there at Davos talking about the potential slowdown in consumer spending from a cap on credit card rates. But, well, just a little bit after that interview, the plot thickened a bit because we've now learned that Bank of America and Citigroup are weighing new cards that would cap rates at 10% for 1 year. Here to kind of make sense of exactly what's going on and the feasibility of it is Bloomberg intelligence analyst Herman Chan, who covers U.S. banks, and Nathan Policy, who covers U.S. policy. And Herman, I do want to start with you first here, specifically on when they say a new card. So they're saying we're not going to cap all of our cards at 10, but we'll introduce something new that will have a cap. Is that the reporting that we're getting?
That's the understanding of how this is going to play out, where it'll be a new offering and it would not affect existing balances that are on consumer, that are already built to consumers. So it'll be a new offering capped at 10%. And frankly, we wrote about this a little bit earlier today. And I'm not sure what the uptake would be for such an offering, because you're going to limit it to like your super prime borrowers.
Well,
and you're not really going to offer the typical rewards program that you would for a wealthier client.
For super prime borrowers, right. And that gets to a question I have for you, Nathan, the idea that the companies are clearly trying to front run the potential of any regulation or legislation on this front here. Is there any sort of meaningful chance that we would actually see Congress sort of enact what Trump is looking for?
Not really. You know, there is a bill out there from Senators Bernie Sanders and Senators Josh Hawley, so an independent and a Republican, that would cap credit card interest rates at 10% for 5 years, but I'm only at a 30% chance of that bill having success, even with President Trump's backing here. There just isn't enough votes, I think, in the Senate to really get this through. But the concern from the banking industry is the political pressure, the bully pulpit, if you will, from the White House, because look, there is bipartisan populist angst about credit card interests, and something has to be done. And that's why I think you're seeing Bank of America and Citigroup reportedly move forward with this idea, because it essentially says to the White House, look, we hear the message, we've developed a solution, now can we please just get out of your focus so that we can focus on something else? I think that's going to be the big story for 2026.
So a 30% chance of success that you give that in 2026. But even still, let's play hypotheticals here, Nathan, because you think about what this would mean for American Express, for Capital One, if this went through. You actually did the math there over at Bloomberg Intelligence.
Yeah, so, if they were to put in a cap of 10%, you're looking around $121 billion in revenue, just back in the napkin math. And a lot of that obviously would go to other credit card companies. There is another policy, though, that we're telling our clients that you got to be careful about, though. It's called the Credit Card Competition Act. Now, this is a bill that would increase competition amongst the networks. So think Visa plus Capital One, MasterCard plus American Express. And this is a bill that, Senators Roger Marshall and Dick Durbin are waiting in their hip pocket to attach at the last moment. And so that is the biggest concern here is that maybe on the swipe fees, interchange fees, if you will, that there will be more competition. President Trump also embraced this via Truth Social a couple of weeks ago. It has a bigger chance of success and something we're telling our clients to just be very careful of.
And Herman, it's interesting, right? Because even if we don't see Congress pass actual legislation here, you write in Bloomberg Intelligence that basically this helps from a PR standpoint.
That's
when
right.
you think about what Bank of America, what Citi is thinking about, they haven't actually come out and issued these cards, but they're weighing it. If you're the CEO of a bank in this day and age, you have to be extending some sort of olive branch to the administration, it feels like.
That's right. And really, does it change anything? In our view, probably not, because banks already offer introductory, low to zero APRs for new customers. So a 10% introductory offer doesn't really move the needle one way or another in our view.
All right. Well, great roundtable, you guys. That is Nathan Dean and Herman Chan, both of Bloomberg Intelligence. A great conversation. And speaking of bank CEOs, Romaine Bostic, they're getting paid.
Well, and a good thing, too, because Jamie Dimon's pay is going up. And you know how much it's going by
Tell
Katie
me.
Garfield?
I'm
10%.
so curious. Wow.
Coincidence? Anyway, the latest filings out here. Jamie Dimon, a $43 million pay package, up about 10% from the $39 million that he got for the previous full year.
All right. Pretty penny.
We should point out, and obviously most of that's in stock and options. It's only like $1.5 million in base salary. It's like, that's peanuts.
Chump change.
How does he live off that?
Yeah, who knows? Got to be frugal. Anyway, let's take a look at some of the big moves in after hours trading. Of course, we did have Intel report earnings. We know that the forecast certainly bummed investors out. You can see shares down about 7%. A different story when it comes to Alcoa, when it comes to CSX. Alcoa shares higher by about 1.7%. And CSX, even though there was a little bit of a miss there when it comes to some of their metrics in the look back, up by about 3.7%. This is the close on Bloomberg.
Venture firms are just piling into any AI story they can. And the valuations for these young companies that we're seeing are astronomical. The FOMO of being in any AI deal as early as you can in the private markets is pretty remarkable.
And that was Thoma Bravo founder Orlando Bravo, doubling down on the idea that AI FOMO is driving private markets activity. Our next guest tracks how these elusive markets are opening up to retail traders as head of his leading alternative investment platform. Joining us now, I'm pleased to say, is Willow Wealth CEO Mitchell Caplan, also the former CEO of E-Trade. Mitchell, it's great to see you in person.
Great to be here, thanks.
I actually want to start there because I'm taking a look at your notes, and you make the point that what we're seeing right now when it comes to private markets and this expanding access, that it really resembles the early days of online investing. And I would love to go back in time because there's a lot of skepticism. There's a lot of pearl clutching right now about whether or not retail investors really belong in private assets. And I wonder if there was sort of echoes of those same worries back in the 90s.
100%.
Yeah.
So I ended up at E-Trade, actually. I built the first sort of, what was the first branchless bank in the US and ultimately became the largest internet bank. Same thing. People were like skeptical around the idea of being able to work with banks in a branchless way, right? Ultimately, we merged it into E-Trade. It was the same thing. Do people really understand what it means to online trade? Do they really understand what it means to online invest? And the thing that made us successful was just education, right? And ultimately, I think that's the path forward for private markets as well.
That's interesting because that was going to be my next question. I mean, how do you translate that experience that you had with E-Trade into what you're doing with Willow Wealth? What takeaways apply to today?
Yeah, it's a great question. So ultimately, when I think about what we're trying to do, and again, our model is direct to consumer. So rather than going through the advisory channel, we're going direct to consumer exactly as we did at E-Trade. And I feel like our first job is not even why private markets. Our first job is what are private markets? Because there's, I think, a disconnect for some people around what it really means to be in private markets. Then our next job is why private markets? How do they help really create a diversified portfolio for you? And then why should Willow Wealth be in the considerations?
The idea that you're going direct there, I mean, I certainly understand it, but then it's like every other person that's sort of creating sort of these retail private products is basically going through the RIA channel. And I am curious as to whether there's any regulatory issues that you've had to jump over that maybe those other folks didn't have to.
Yeah, so I think absolutely. First of all, we're both a registered investment advisor and a broker-dealer, so we're highly regulated. But I think even more importantly, it's the idea of really understanding that you have this responsibility toward education, right? And that because you're actually going directly to the consumer as opposed to through the advisor, you have more control of what you're actually saying. You know the message and the education that you're providing is being absorbed by the customer.
I do have to ask you, though, about some of the concerns. And one of the concerns is that there are a lot of private capital companies that, in theory, might just be trying to dump a lot of slop onto the individual investor in a way that they wouldn't have done on the institutional investor. A, what are the folks on your platform meaning the types of private assets, are they looking for? And two, is there enough transparency around those assets that you can appropriately educate them on it?
Yeah, so it's a great question. Yeah. I would say, first of all, I do believe we can educate, right? Again, you're really spending time with them on our website. So it's a digital experience, but you can provide them with education in a way they can really absorb it and understand it. So I think that helps. The other thing is our business model really focuses on people who are in the emerging wealth, so emerging high net worth. So it means they're really above mass affluent, below high net worth, ultra high net worth. Okay. They're qualified purchasers, they're accredited investors. So by definition, we're focusing on people who have a higher level of sophistication. Doesn't mean that education is important. It just means it's something you actually, through our model, really focus on.
And what exactly do they want when it comes to the private markets? Because that can mean a lot of different things. I mean, it can mean, alternative assets, real estate, et cetera. It can mean private credit, or it can mean private companies. And certainly, I mean, I spend a lot of time in the ETF world, and how to fit private companies into these retail-friendly wrappers is one of the big thought exercises going on in that industry. But what demand are you seeing for specific types of assets?
So remember, Willow's been in existence now for about 10 or 11 years. So when it first began, it was really sort of a pioneer in trying to create the access to private markets in an addressable way at a price point of $10,000, not $500,000 or $1 million. And so what we have seen over our operating history, and I got involved when our family office led the investment in the Series C. That's ultimately how I got to Willow Wealth. And when we did, what we saw was consumers wanted different things at different times. So macro controls some of it, micro controls some of it. Interest rates move up. What do people are more focused on? They tend to be focused on shorter duration, higher coupon. The opposite is true when you get into a bullish market. And so a lot of the macro controls it, but then you have micro. People who are trying to build wealth, they need to achieve certain goals, so there are specifics that are relevant to them. So they're picking, and we're helping, trying to educate, but also curate We're trying to create a host of products in the form of whether it's an interval fund, a drawdown fund, ultimately a single asset deal. It could be a co-invest in a way in which we're really curating for them the experience and making it easier.
I'm curious though about that curation too and how this stuff gets packaged. Are people looking for maybe singular investments, meaning a singular asset, or do they want that collection of assets, structured in a way that addresses the issues, liquidity concerns, et
So
cetera,
the
et
answer to
cetera?
your question is yes.
Okay, all right.
That's true.
Yeah.
So
what do you think is going to dominate most?
So one of the things that we developed in the last year was we built a product within Willow that we call Willow 360. It was effectively the first robo-advisor for private markets. So we actually hired Wilshire to act and oversee 3 different funds, Carlyle, Goldman, and Stepstone, and the allocation among those 3 funds is driven by what our customers' goals are. So it's really a set it and forget it in a way that they have access but can build wealth for the long term. There's real demand for that. At the same time, there's equal demand for some of our single asset deals as well as our funds.
All right, Mitchell, really great to catch up with you. I find this a fascinating vehicle, particularly given everything we talk about on this show, and everyone's sort of really hyper-focused right now on that more access to private assets. Mitch Caplan there, co-founder of E-Trade and now the CEO over at Willow Wealth. When we come back, we're going to have that conversation. We teased it a little bit earlier. The renowned designer Jonathan Adler, Katie and I had a chance to sit down with him and talk about what's next for his brand.
The key to my success, and as much as I've had any, is trying to be singular, insular, and authentic, and being on a very peculiar and personal aesthetic journey.
Well, despite tariffs aimed at luxury goods and the furniture sector, one brand is moving full steam ahead. Jonathan Adler. We recently spoke to the president, Mary Beth Sheridan, as well as the chief creative officer and renowned designer, Jonathan Adler himself, about how the company is navigating trade uncertainty and why their designs continue to resonate with consumers after 3 decades. Here's part of that conversation.
Customers today are going from buying just a product to really buying into a brand and a lifestyle. And it's really important that that brand, that lifestyle represents how they see themselves and how they see the world today. So as long as we continue to carry on with great quality, great craftsmanship, unique designs, as you just discussed with Jonathan, we see lots of growth for more customers, whether it be a small object in a home or designing the entire home or even a commercial project.
Well, to make this personal, which I like to do, I was taking a look at the Jonathan Adler website, and I thought, that snake looks really familiar. Oh my God. And then I realized that I have a ruggable Jonathan Adler rug sitting under my dining table, and I thought that was really interesting, sort of infiltrating that channel and reaching the customer that way. So how do you approach those sorts of partnerships?
I want to meet the customer where they are and just make fantastic design at every price point. And I think, Ruggable has been an incredible collaboration. They're an amazing company. We've made amazing things with them that are at a somewhat accessible price point. And, we also make really expensive stuff. My attitude is just whatever I'm doing, make it incredible.
You sort of, traverse the pricing spectrum. You make things that are more accessible, such as ruggable rugs, and then you have the very expensive. And in the environment that we are right now, with prices still very high across industries, the question of tariffs, where are you seeing consumers go in that environment? Are there any trends about trading down, or what you're seeing when it comes to the higher end as well?
Yeah, well, tariffs, inflationary pressures, it all puts a lot of pressure on our costing. However, myself, the entire team is hyper-focused on controlling what we can control. And to that end, we have a global sourcing network that is extremely diversified. Jonathan and the team have built, great partnerships and relationships with this vendor and this, partnership community. And we feel quite insulated in that regard, and that we've got, sort of being on the offensive strategies to control our pricing and our factories, our sourcing where we can. And as long as we're putting forth the great product, our customers are still responding.
When you start start to hear things in the news, though, about maybe additional tariffs or retaliatory tariffs on the U.S. or however sort of the mix is, do you react to that, or do you just sort of wait and see where things go?
Well, you know, I think being on the offensive like that, we have to, we don't have a knee-jerk reaction on a daily basis. We have to see where things settle in and then take, like I said, what we can do, what we can control, we control it so that we're here to, you know, run a business, but we're also here to make sure we service our customer with fair product and fair pricing.
Let's talk a little bit more about where you're going next, because I'm taking a look at the notes you sent over to our producers, and you really highlight 3 areas of expansion. You have wholesale expansion, you have your digital acceleration, and then you have interior design. And I want to talk about that. What that actually means when it comes to your interior design studio, you know, what sort of projects you're taking on.
Well, yeah, interior, I started out as a potter, which is sort of the essence of what I do and how we built this company. I started out just as a potter making pots, and over the intervening years I've expanded to make furniture and lighting and rugs, all with kind of what we call modern American glamour is how we would describe our style. And I've taken that ethos and also use it in interior design projects, from private residences to huge hotels. And it's kind of all of a piece, and I find doing interior design informs my aesthetic, and they all kind of are complementary to each other. And we're doing a lot more interior design.
You referenced being a potter, and one of your big breaks was getting your products into Barney's department store, which, for those who don't know, was kind of the premier luxury department store here in New York City. Unfortunately, it's closed, and I do wonder, when you look at some of the struggles we've seen in department stores and other retail outlets over the last few years, particularly those that did actually provide an entryway for an unknown potter to sell their wares. Is there space for another Jonathan Adler to come up? Like, who's going to be the platform that gives Jonathan Adler his break?
I mean, it's a deep question, and I am sort of blessed and extraordinarily lucky. I was an unemployed and unemployable potter who, when he started making pots, I was 27, I had failed at everything, and I thought that I would make pottery and just kind of hawk my wares at rain-soaked craft fairs for the rest of my life. I never expected, you know, to make any money or anything. Barney's saw my pots and gave me a break and really launched me into the world. And Barney's sort of had this special magic dust that they could sprinkle on young designers and create brands and foster creativity in the most extraordinary way. And once I got into Barney's, it was sort of like once you could get over that speed bump and get in, then all of a sudden you were a known quantity and you could really expand. So I think at the time, the gatekeepers, there were fewer gatekeepers, but once you can get through the gate, then you could blow up. Now I think it's much easier to get a little bit of a foothold because you can market on Instagram, and you know, there's so many new points of distribution, but it's much harder to be noticed and gain scale. So in the past, the challenge was to get past the gatekeeper, which in that case was Barney's, and then you could blow up. And now there ain't gatekeepers, but nor is there the same opportunity for scale. So my kind of career, I don't know if it's replicatable. I think it was just fantastic timing. And you know, shout out to Barney's. It was an extraordinary, extraordinary vibe and company.
And that was part of our conversation with Jonathan Adler, of course, who founded the Jonathan Adler Company, and Mary Beth Sheridan, who just took over as CEO and president a few months ago. He was a great guy, a great conversation, and really kind of illuminating just into the retail space, luxury space, and everything in between.
Yeah, and I thought his comments just there at the end about how he doesn't know if his career path in this day and age would be something you can replicate. Just a really interesting sort of sign of the times and where we stand.
Yeah, absolutely. Here, as we close out our coverage here on this Thursday afternoon, to push ahead to what to keep your eyes on over the next 24 hours. And, well, the BOJ, Bank of Japan, they've got a rate decision that's coming out overnight, and I guess it's taking on a little bit of a different tone given the sell-off that we saw in JGBs earlier this week.
Yeah, absolutely. Going to be interesting to see the commentary coming out of that. And then 9:45 a.m. over here in the U.S., we get S&P Global Manufacturing and Services PMIs, and then 10 a.m., some more data.
Yeah, UMich sentiment. I actually like these sentiment numbers as well as the Conference Board's leading index here, so maybe a little bit of a forward look potentially as to where we go with the economic data.
And it feels like it just started, but we're wrapping up our coverage from Davos.
Oh, no.
And should be interesting. ECB President Christine Lagarde, she is set to speak.
Yeah, it's been an interesting Davos. I heard they had like record turnout this year. Even Elon Musk showed up. Remember he used to hate Davos?
Oh, I know. Yeah.
All right, well, we'll be back tomorrow, Katie and I here on The Close for all your political coverage. Stick around. Balance of Power is up next.